You asked, so I'm going to tell. Let's talk about slave mortgages. I first learned this information from a book called The Half Has Never Been Told: Slavery and the Making of American Capitalism by Edward Baptist. There's also a new book coming out that I plan to read by Sharon Ann Murphy. It's called Banking on Slavery, Financing Southern Expansion in the Antebellum States. It came out last year. In the 19th century, a lot of American banks engaged in something called discount lending. These were short-term loans designed for business people, for merchants. The merchant would issue a promissory note to the seller in exchange for goods, promising to pay the full price at a future date. The seller would then take the promissory note to the bank to be discounted, and the bank would loan them the face value of the note. The banks liked these kinds of loans because they were A, short-term, and B, backed by actual goods for sale. So as soon as the sale was completed, the debt would be paid. If the debtor failed to repay, then the court would sue them for the value of the note, and if they couldn't pay, the court would authorize the sheriff to basically confiscate all their valuable property, including their slaves. And Southern banks did a lot of this in the 19th century, confiscating and selling slaves in order to satisfy unpaid debts. Banks regularly accepted slaves as mortgage collateral in order to secure the existing short-term loans. After the War of 1812, there was this big economic boom, massive land expansion. The prices of slaves increased exponentially, and a bunch of Southern banks were popping up on the frontier, places like Kentucky, Tennessee, and Mississippi, because the United States had stolen the land from the indigenous people and driven them off to reservations. So all that land was now free to cultivate rice, cotton, sugar, or whatever, and everybody was buying and selling slaves, marching them down from Virginia and North Carolina down to Mississippi, to Georgia, to Tennessee, etc. And a lot of businessmen were really racking up the debt, and they were able to not repay the initial loans, but like basically refinance them, extend the loan by offering new collateral, including slaves. And they managed to convince these new banks on the frontier that, oh, it's actually better if we offer our slaves as collateral. They're a much more secure asset even than land. So these frontier banks began to offer even long-term loans that were secured by slaves. And slaves had been used as debt collateral before that in colonial times at the founding of the nation, but it became much more rampant, and that industry really expanded in the early 19th century because of all the rampant land speculation. Prices going sky high, real estate was really valuable, people were borrowing, banking on the fact that they could make the money back, make their fortune, and pay all the banks back. Does that sound familiar? In fact, for most Americans, the entire concept of a mortgage was first experienced by them in the form of a slave mortgage, not with real estate. And this was global, particularly London-based. A lot of that money lending to slave owners who were using their slaves as collateral, who were getting mortgages out on their slaves, a lot of that money came from London and Amsterdam. It was a global financial market. Now, remember those mortgage-backed securities and CDOs I talked about a few days ago? Those types of securities were invented during this time. A bunch of mortgages bundled together, forming a bond, a type of security, right? Except the only difference is, in the early 2000s, it was houses. In the early 19th century, it was slaves. There were mortgage-backed securities bundled together with slave mortgages and collateralized debt obligations, although they weren't calling it that then. But it was the same thing. And these securities were being traded on stock markets all around the world. Enter the Panic of 1837. Every bubble burst, right? So the bottom fell out, huge economic depression. A lot of the frontier banks failed after investing in all these plantations and in these slave mortgages throughout the 1830s was helping prop up the system and serving as a financial safety net for all these slave owners. Remember the credit rating firms like Standard & Poor's and Moody's that I talked about in my previous video? Those companies had their origins in the Panic of 1837 as well. That was when credit rating companies first started to pop up. One of the major culprits of this was a bank called the Consolidated Association of Planters of Louisiana. And while it sounds like a trade organization, it was actually a bank. So slave owners mortgaged their slaves, and they were allowed to borrow up to half of the value of the slaves they put up. So you could borrow up to half of your assessed property from the CAPL in banknotes. Now, to convince the market that these banknotes were good, here's what they did. The Consolidated Association of the Planters of Louisiana convinced the Louisiana legislature to back $2.5 million worth in bonds, due in 10 to 15 years, bearing 5% interest, with the faith and credit of the people of the great state of Louisiana. And the English merchant bank, the Baring Brothers, agreed to advance the CAPL the equivalent, 2.5 million in sterling bills, and market the bonds on the European securities markets. So not only were these slave mortgages securitized and sold on international markets, but they were guaranteed by the state of Louisiana. So slave owners were able to monetize their slaves in a way that they never had before. They can securitize them and leverage them multiple times on an international financial market. This left a vast amount of money available to them. A typical bond was for $1,000, in units of $1,000, which was at the time the average price of a field hand. So bond buyers were able to purchase a commodified slave, similar to the mortgage bonds of the early 2000s, like individual pieces of millions of slaves all bundled together. So investors worldwide were able to make huge profits off of slavery, but without having to assume the risk of owning a slave yourself, like feeding them, housing them, or finding them, going after them when they ran away. They assumed none of that risk. So when the bottom fell out, when the panic hit, who came to the rescue? The state of Louisiana. The state of Louisiana bailed out many, many, many slave owners who had mortgaged their slaves, those mortgages of which were included in those bonds, those mortgage-backed securities that were sold all over the world. And that was America's first bond market. People. The American economic system, our banking system, has its roots in slavery. It was an incredibly profitable institution for every single person involved, from the merchant to the banker to the broker to the owner themselves to banks halfway across the world. Everybody profited off of this. God bless America, right?